Hello, I'm Donald Leggett. Welcome to the latest Focus IR London South East CEO interview. I'm joined again by Adam Davidson, and he is the CEO at Trident Royalties. Trident is a fast-growing, diversified mining royalty company managed by an experienced team of mining professionals. Adam joins me today to explain how royalty streams and outtakes work, what makes a good deal for him, and why royalty companies are a good way to get broad exposure to the mining and commodities markets. Welcome again, Adam. Fantastic to see you.
Yep, good to see you.
Great. Are you having a good day today, Adam?
Yeah, absolutely. We're very busy, but busy is good.
Busy is always good. Okay, let's crack on with our interview. I know that mining for gold, lithium, or any other commodities is capital intensive. It's very upfront, and a mine project can take several years or more to get into production. So where do royalty firms like yourselves fit into the funding picture? Why do those mining operations go to you for royalty?
Yeah, it's a sector that's really evolved, and in some ways we've described it as still being in its adolescence to a certain extent. If you rewind 20 years or so, royalties were not a major part of the mining finance landscape. Where they really the genesis of royalties and streams were, if you had a precious metals mine, say that spit out, you had a base metals mine that spit out a little bit of precious metals. So you had a copper mine and there was a little bit of gold or silver byproduct. But what you found is that the gold and precious metals focused royalty companies and streamers traded a much better valuation and could take that byproduct from you as the miner. Could pay up for it because they're trading at a higher valuation than you as a base metals miner. And there was a bit of an arbitrage there that kind of worked for both sides. So that was sort of the genesis. But you fast forward to today, and it's really evolved to now. It's not uncommon at all to, when you're building a mining project, to raise equity, of course, to have some debt, but then to have a mining royalty or stream sort of built into that financing package. The reason that the miners are open to royalties is a few facets. One is that it's a non-dilutive to share capital source of financing. So rather than go out there and raise, making up numbers, but 30 million in equity to advance your project through a study and through drilling, perhaps you'll do half that through a royalty so that you can only do 15 in equity and you limit your share capital dilution. So that's one of the appeals. And then relative to debt, obviously debt has fixed payment schedules. They have covenants and ratios that if you trip over, you can find yourself in trouble. But with a royalty, we just get paid a percentage of their revenue. So it's a very covenant-light sort of passive instrument that gives them a bit more flexibility relative to debt. So it slots in right in between kind of equity and debt with regards to the funding mix.
Okay, and for those less familiar with Trident Royalties, explain to people the business that you've built up, the portfolio that you've built up since you launched on AIM in 2020, 3 years.
Yes, yeah. So this is probably our point of differentiation. Most of our peers, as I mentioned, their genesis was in gold-focused royalties and streams, and primarily in sort of taking off that byproduct from base metals producers, and then it grew from there to primary financings of gold projects, and now that's a very big sector. And in aggregate, the mining royalty sector is circa 80 billion in market cap. Of that, 75 billion, call it, is precious metals focused royalty companies. They'll occasionally delve into other commodities. But very, very focused on precious metals. And yet precious metals makes up about a quarter to a third of the global mining sector. So you've got almost the entirety of the mining royalty sector focused on what is a quarter to a third of the total mining sector. You've got this entire 2/3 of the mining sector that's not very well covered from a royalty perspective. And it was that dislocation that seemed to be an opportunity to us, and I think is proven out through our strategy. Then when we listed, we had one single iron ore royalty that we've acquired. Now we have exposure to mineral sands, iron ore, silver, copper, gold, lithium, and looking to continue to expand that broad exposure. So, we'd like to remain open and opportunistic on gold, noting that there's more competition, but it's really the remaining 2/3 of the mining sector that we see sort of happy hunting ground for us. And we've done now, I think 14 transactions over the space of the 3 years we've been listed. So there is quite a bit of opportunity out there, and I think we're through that proof of concept phase now.
Okay, that makes a lot of sense. So if you can explain to us in very basic terms how a royalty works and what you get for your money, just take us through how it operates.
Yeah, so they're pretty simple instruments in many respects. They entitle us as the royalty holder to a percentage of the underlying operations revenue. So if they produce 100 million in cash a year, and we have a 1% royalty, then we receive 1 million from the operator. Now that conveys with quite a few benefits, because as many investors in mining equities may understand, you may generate 100 million in revenue and still generate a $10 million loss, for example, if commodity cycles in a bit of a trough, or if your operating or capital expenses have blown out for the year. Whereas a mining royalty company, we don't have a cost structure. These are financial instruments, so we're getting paid quarterly or monthly our share of revenue from that underlying operation, and there's no further cost associated to us, and we're not exposed directly. And importantly, we're not exposed to their costs. So if the mine's unprofitable, obviously we don't want to see the mine shut down, because then our revenue stream ceases. But we're not exposed to their profit margins, and they can swing wildly in commodity cycles. We've got much more stable revenue flow, because it's simply the production times the commodity price times our royalty rate, and that's how the cash flow works with regards to a royalty. And yet we still get that exposure that you buy mining equities for, and that if they extend the mine life, or they have exploration success and they double the planned production profile because they've grown the resource, well, that all impacts their revenue line on the P&L, and we get exposure to that. It's just the cost side that we're not exposed to.
In the silver royalty you just bought in Mexico, I noticed that there was a milestone payment in there. So what is a milestone payment?
Yeah, we've got, you see these structures sometimes. They're just kind of tack-ons. In that particular case, 12 months after first silver production, we get an $8.75 million payment. On our Thacker Pass royalty, there's a buyback right to the operator, which is somewhat similar. Effectively, at their election, they can buy down the percentage of the royalty. And it was structured such that they're highly, highly incentivized to do so. Otherwise, it's an 8% royalty, which is a very heavy royalty load. So it's assumed before they get into meaningful production, they'll exercise that buyback. In that case, that would see 13.2 million come back to us, we'd expect in the next few years. So you see these occasionally in royalties where you get these little kickers built in. And in the case of both those, they allow us to take, in the silver royalty, all of our deployed capital is back off the table once that payment's made. And in the case of Thacker Pass, we get nearly 50% of our deployed capital back. And that's before these things have actually started producing and paying.
So how come you guys are so clever?
Well, I'd like to think we're clever, and I think it really comes down to the strategy, in that you can count on one hand the number of royalty companies that are looking in the non-precious space. So it's just a bit of an untapped market. We're conscious that window of opportunity may not be open forever, so we're very focused on building out the portfolio while it is less competitive, because I think inevitably we're going to see more competition arise as groups like ourselves and some others have success in the non-precious space.
Okay, here we go. Let's continue to educate. Trident invest in royalties, they invest in streams, gold offtake agreements. Talk us through the different types of all these instruments and what each adds to your portfolio. If you could give me examples as you go, that would be most useful.
Yeah, sure. Yeah, I think so. Royalties I've already touched on. They just give us a percentage of revenue, and that's the bulk of our portfolio and really the focus. Streams
so
and
it's mainly royalties, yes?
Mainly royalties. Yeah, we did buy a portfolio of gold offtakes, which is very similar to a stream. Effectively, a stream entitles you to a percentage of production from the mine, and you pay a fixed, usually well below market rate. So you may get 20% of production from the mine, and you pay 20% of the prevailing spot price, the commodity spot price. And in the case of an offtake, you may get, say, 20% of production from a mine, but you pay the lowest price over a trailing 6 to 8 day period. So very, very similar sort of instruments there. And
you've still got to pay for it. With streams and offtakes, you still have to pay some money for it.
Although on a net basis, because if you just immediately sell the material, obviously if you're paying below the lowest price in the case of a gold offtake, or you're paying, say, 20% of the prevailing spot price on a stream, then you're immediately in the money. So you can't really lose money. If you wanted to hold the material and sort of take a long view on the commodity, then you would potentially be exposed. But we don't operate that way. We treat these things similar to royalties, and that when it comes in, we're clipping the difference between spot and the price that we have to pay for it.
Okay, when you're assessing royalties, streams, offtakes, what are your favorite metrics? What makes a good royalty, and what are you looking for? You know.
Yeah, I think in this case it's not dissimilar from my days in mining private equity. You're looking for obviously a royalty over a good defensive asset. I mentioned we're not exposed to cost, and that's not entirely true. There's a binomial risk where if the mine shuts down, we're exposed to that, and then that's obviously driven by their cost structure. If they're not profitable, then the mine's not going to survive the cycles. And as we know, commodities move in cycles.
But likewise, near production, you take near production royalties. So you've got the risk of the Thacker Pass not getting its approvals and so on and so forth.
Yeah, exactly. It's no different from investing in equity in pre-production assets in that regard. I mean, when we acquired the Thacker Pass royalty, it was off the back of them getting the initial federal permit with the knowledge that it would be appealed, and then the appeal would be appealed. So there was permitting risk, and there was a little bit of potential financing risk in the sense that if they couldn't raise the required capital, then obviously the project wouldn't be built. Although we always thought that was a pretty minimal risk because it's a tier one asset in a tier one jurisdiction, so the finance will be available, and I think we're seeing that has been the case. But importantly, it's worth touching on one of the key benefits of royalties. As I mentioned, you're not exposed to that cost. So Thacker Pass, when we bought the royalty, the latest study flagged a capital expenditure to build the project of circa 550 million. You fast forward to the most recent study issued this year, it's now 2.3 billion. So that cost needs to be carried by their shareholders and debt. They'll debt finance a good portion of it, I'm sure. But us as a royalty holder, we get our percentage of their revenue as they expand production. That means there's a capex ticket associated with that. We don't bear that burden. So you're in an instrument that shares many of the upsides of equity, some of the risks of equities, to be sure, but is a much better downside protected instrument, and in many respects kind of a derivative style instrument that gives you the good upside exposure. The reason people invest in mining equities gives you that style of exposure, I think, from a better protected position.
Does your job get easier, Adam, as you buy and sell assets, the portfolio matures and the cash flow increases?
It does. I mean, to a certain extent, you want to see that cash flow come in, and so I think as we get more broadly diversified, just as your investors would be looking at their portfolios, and then more names they have in them, the less they're exposed to one single name. So that's certainly a factor for us. And when we listed, we had just one single iron ore royalty, a nice paying royalty. We now recovered our deployed capital, and we're into profit on that asset, and it's got some life in front of it yet. So has been a good investment for us. But there's always that risk that iron ore could have tanked over the last few years, in which case you'd be highly exposed to that individual asset. But now that asset comprises, I think it's 3 to 4% of our overall NAV, so much less exposed as we get more diversified. And similarly, we were exposed a lot to iron ore in addition to that particular asset. But now we've got exposure to mineral sands, iron ore, silver, gold, copper, lithium. So we're not as at the mercy of individual commodity prices either.
Okay, you just outlined the portfolio today. What's the portfolio tomorrow? Because you've got $30 million in cash. What acquisitions might you be thinking of making?
Yeah, of course, I have to be careful about what I allude to here, but we're in a pretty strong position, as you mentioned, with 30 million in cash ready to deploy. We're in a good position to deploy that capital. I think we're finding that mining companies, equity markets have softened quite a bit over the last 12 to 18 months. And then there's always a bit of a lag before the opportunities arise for royalty companies, because the miners and project developers, they'll have a bit of a cash balance. As the market softens and they're whittling through that cash balance, they're trying to hold out because in many cases they don't want to lay a royalty in over their property because the royalty's there in perpetuity. No mining management team gets fired for going out and doing an equity raise. It's the safe option relative to a royalty financing. But I think we're at the point now where prices have been soft for so long. They don't want to do a raise below their most recent raise price from maybe a year or two ago. So it's sort of open hunting ground for us at the moment with regards to deploying capital. And when I look at deals in our pipeline, that they are sort of the full breadth of the mining sector, where we're looking at some battery metals, we're looking at base metals, we've even got a couple of precious metals royalties that we're contemplating. So I think some good news to come is our expectation in the back half of the year.
So now now is actually a very good time to be buying royalties.
Yeah, we believe so. Yeah, and a good time to be buying Trident, to be fair. I bought some shares here recently, as was announced, as did our CFO. We were in an open period, so we took advantage of it. I think we're pretty excited. We've got a portfolio that's maturing. I don't think the share price has reflected that. But it's been materially de-risked as assets like Thacker Pass have cleared their permitting, are now in construction. So the value has never been more sort of crystallized, I suppose, in some respects. And then we can see the opportunity in front of us, and we're cashed up to go out there and take advantage of it. So we're pretty excited about what's to come.
Adam, I think that's an ideal time to stop. How fantastic. What a great finish. Adam Davidson, CEO at Trident Royalties, thank you very much for explaining to us how the Trident Royalty business works. For more company information and to access the company bulletin board, please go to the Trident pages on London South East. And meanwhile, do follow us on Twitter. That's at London South East, and also at _FocusIR_. Or register on London South East YouTube to receive alerts to our next Trident Royalties interviews like this one. Thank you very much indeed for watching.